Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26th year in business. It's Saturday, March 15, 2015, and the title of today's audio blog is Death of the Brics, and with them the global economy. Now, it was a horrific close to a horrific week in what is rapidly morphing into the most horrific political, economic, and financial year of our lifetimes. And no, I'm not exaggerating one bit, particularly as regards the 6.9 billion people living outside the United States, whose currencies are not only plunging far more rapidly than 2008, but in many cases in Russian ruble-like fashion, with the potential to head into Zimbabwe-style inflation in a hurry. Not that things are so hot here either, as across the board economic data is collapsing to 2008 crisis low levels, such as retail sales, import and export prices, and the sales to inventory ratio Thursday, followed by consumer sentiment and producer prices yesterday. And this just a week after the PPT-supported NASDAQ recaptured its dot-com bubble top of 5,000, as the so-called unemployment rate plunged to its pre-2008 crisis level. Which tells us, of course, just how rigged financial markets have become and fraudulent the economic data, as the odds of the stock market, at least until this week, hitting all-time highs as America's Economic Surprise Index hit its lowest level since the bottom of the 2008 economic crisis, would be zero in a freely traded market. I mean, think about how many highly paid, I might add, oil workers have really lost their jobs this year, as opposed to the mere 2,900 the BLS claims. To that end, we learned today that the Baker Hughes rig count plunged another 6% last week, completing a 14-week collapse of 41%, surpassing the previous record collapse of March 2009, and raising comparisons to the historic rig count implosion of the mid-1980s. And yet, U.S. oil production hit a new all-time high last week, prompting the very scary worldwide realization of what I have been pounding the table on for months, as highlighted by my direst prediction of oil article on January 2nd, which is that crude oil, or as I referred to it in a previous article, that other Achilles heel, has perhaps the worst supply-demand imbalance of any commodity on the planet, aside from lumber, which is collapsing as rapidly as the echo housing bubble the Fed created. And due to everyone from indifferent majors to nearly bankrupt shale producers to insolvent governments desperately needing cash, it's highly unlikely that the trend materially changes anytime soon. In fact, U.S. storage facilities are now being forecast to actually fill up by this summer, an utterly unheard of catastrophe for the industry that represents 1/3 of all S&P 500 capital spending, and likely far higher percentages in a significant number of nations, like Brazil, for instance, whose currency plunge is making the euros look mild in comparison. Heck, just look at the stock of Brazil's state-owned oil monopoly Petrobras, down an incredible 93% from its 2008 peak and 75% since August of 2014 alone. If you want to see just how damaging the current historic oil price implosion can be. And by the way, if indeed Iran agrees to slow down its nuclear program, as is expected this week, they will likely end the sanction of Iranian crude oil exports to the West, yielding new massive supply hitting the markets coincident with already collapsing crude prices. In other words, I wasn't kidding when I wrote crashing oil prices portend unspeakable horrors back on October 15th, when, by the way, WTI crude was still $83 a barrel compared to today's close of $45 a barrel, which, by the way, is just a buck above the January 29th low before the oil PPT emerged to try and bully the world's largest commodity market with limitless purchases of paper futures and ETFs, of which I can joyfully claim, ding dong, the oil PP's dead. Just as the Swiss National Bank's franc euro peg, and shortly not only the European Monetary Union, but the credibility and solvency of all central banks. As for the financial markets, the powers that be have already lost control of essentially all currencies and all commodities, other than copper, which continues to be persistently manipulatively supported, and as well as the support of billions of people as new radical political parties rapidly gain control the world round, as in Greece, Spain, Italy, and France. And of course, the granddaddy of lost control will occur when, for the title of another recent article, the last to go markets like the Dow Jones Propaganda Average, the German DAX, the Japanese Nikkei, and countless sovereign debt markets spiral out of control, and inevitably paper, gold, and silver when the covertly operated New York gold pool is destroyed. Yes, the European Monetary Union, created at the peak of the post-gold standard abandonment economic bubble in 1999, based on a combination of misguided and fraudulent assumptions and doomed to failure from the beginning. Back in July 2011, when the first spasms of European instability were felt, I predicted the euro would fall apart within 12 months. Well, exactly 12 months later, collapsing pigs and some non-pigs, bonds and stocks, prompted Draghi's infamous whatever it takes speech. And 33 months after that, Europe's political, economic, and social environment is multitudes worse, with the euro literally hanging by a thread. As I wrote in April 2013's Greek Tragedy, last month's Countdown to Grexit, and last week's Grexit Guaranteed, Greece is completely hopeless and destined for economic and monetary isolation, either voluntarily or otherwise, likely within months. Heck, just yesterday, Greek Finance Minister Yanis Varoufakis admitted Greece would never pay back its debts, as the Eurogroup is literally asphyxiating the Greek economy. And today, one day after Greece passed a law allowing its government to plunder pension funds to pay off debt, both the German finance minister and EU Commission president claimed that Greek bailout talks had ground to a halt. Greek stocks and bonds are plummeting. The National Bank of Greece, which I long ago deemed the world's most insolvent financial institution and the world's most important stock, has seen its stock plunge to nearly its all-time low. And of course, the euro collapsed from 1.11 per dollar a week ago to below 1.05 per dollar today, or yesterday, in an historic loss of purchasing power for the world's second largest currency. And this just days after Greece's president, Alexis Tsipras, threatened to seize German assets as restitution for Nazi war crimes, whilst the so-called Troika, i.e. the European Commission, ECB, and IMF, actually proposed that Greece suspend public salaries and pension payments for 2 months to enable short-term debt repayment. In other words, as I loudly screamed in my What's More Fraudulent, Mining Resources or the Greek Debt Deal audioblog, Greece not only has not a chance of avoiding a Grexit, but likely will experience it well before the so-called 4-month debt extension period concludes. And as for non-PIGS economies like Germany, which have experienced exploding stock and bond markets as the investment world front-runs the ECB's insane hyperinflationary QE program, which started on Monday, by the way, it shan't be long before blood and tears are running through their streets too, when Greece defaults on its 400 billion euros of debt, setting off not only an historic derivatives implosion, but a debt jubilee contagion across not only Europe, but large swaths of both the developed and undeveloped world. To that end, consider that Europe's largest bank, Deutsche Bank, actually failed the Fed's layup of a stress test this week, even after last year's $7 billion heavily dilutive equity offering, demonstrating why just 2 years ago, the vice chairman of the U.S. FDIC characterized Deutsche Bank as, quote, horribly undercapitalized. Gee, I wonder how Deutsche Bank and Germany will fare when a pig's default contagion spreads like the Ebola virus. And contagion it most certainly will be, per what Greek Defense Minister Panos Kamenos said yesterday, i.e., if Greece explodes, Spain and Italy will be next, and then at some point Germany. And thus, in the words of the great David Stockman, quote, indeed, the best bet in all of Christendom at the moment is that the EMU, that is the European Monetary Union, at least in its current configuration, is going to blow sky high. Which brings me to today's principal topic, although I plan to end with a discussion of Wednesday's potentially historic FOMC meeting, when, barring unprecedented market manipulation success, the long-awaited Yellen reversal potentially looms, i.e. the Fed admitting the economy is not only not recovering, but alternatively declining, as clearly the fraudulent 5.5% unemployment rate is far less important than yesterday's negative PPI, Thursday's negative retail sales and export prices, the 6-year low in crude oil and commodity prices, and oh yeah, the falling stock market, which frankly is all the Fed really cares about. And if not a full-blown policy reversal, at the least following up the, quote, most unequivocally dovish FOMC statement in memory at last week's Humphrey Hawkins hearing, a Yellen reversal light in which the Fed at least claims to be more likely to ease policy in the future than tighten it. Which, of course, would prompt an historic precious metals rally, given the historically suppressed levels the cartel have pushed them to, under the propaganda premise that gold and silver were suffering from fears of Fed rate hikes, which somehow didn't affect either stocks or bonds, which of course not only doesn't jibe with logic or history, but isn't even consistent with competing propaganda claiming gold and silver are declining due to deflation as the stock market surges to an all-time high. Back to that in a second, although I'm not sure how much loudly I can shout that the dollar surge that is wiping out literally dozens of currencies like a torch to a gasoline-covered rag has absolutely nothing to do with U.S. political, economic, or financial strength. LOL, as the supposed debt ceiling is set to be exceeded tomorrow, whilst Obama makes a horrifying proposal to allow the nation's $1.3 trillion of imploding student loans to be written off at the expense of taxpayers. Instead, it is entirely due to an historic flight to liquidity as the entire world realizes the big one has arrived, which is probably why yesterday's historic dollar surge, making Wednesday's stratospheric launch, which prompted my Currency Carnage article, appear mild in comparison, commenced exactly when the aforementioned horrifying plunge in U.S. consumer confidence was published, which, by the way, is a first-class oxymoron if I ever heard one. Yes, listeners, following this week's horrifying trading, it is no longer debatable that the big one has commenced, as the parabolic growth in debt, historic commodity crash, and unprecedented global currency implosion that commenced in the fall is taking on epic proportions. Remember, the signs of such were present when I wrote 2008 is back all the way back on October 7th. But even I am in awe of just how rapidly the entire global economy, monetary system, and political structure have collapsed. Back then, I claimed the only difference between 2008 and today was the manipulation of key markets like the Dow Jones propaganda average and paper gold and silver prices. While today, despite the US dollar having been pushed to cataclysmically high levels for the dying mining industry, the Dow is finally starting to succumb to the weight of its historically high valuation amidst the weakest fundamentals of our lifetimes. And even if the PPT is able to hold it up a bit more, particularly with Wednesday's all-important FOMC meeting looming, it will no longer be able to mask the aforementioned political, economic, and monetary damage the world round, which at the pace it's deteriorating is likely to yield a significant, horrifying black swan event any day now. And by the way, how ironic is it that Wednesday's FOMC meeting, which may well coincide with some version of a Yellen reversal, coincides with the, quote, two-meeting prediction of a rate hike Janet Yellen espoused just 3 months ago at the December 28th meeting. I mean, wouldn't it be a hoot if the Fed hints at the possibility of negative interest rates on Wednesday as opposed to even the piddling, useless quarter-point increase the MSM Wall Street morons have been crowing about for 2 years? Anyhow, recall that not just in this year's predictions, but last year's, I predicted the terminal stage of history's largest fiat Ponzi scheme would be characterized, to the chagrin of dollar bears the world round, by a dollar index utterly exploding upward as global investors flee to said flight to liquidity, and eventually gold and silver, as a combination of monetary implosion and cartel destruction, conflate in an historic stampede of fear. To wit, from my 2014 prediction article of December 30th, 2013, when, by the way, the dollar index was still at 80 versus 100 to close today's trading. Quote, multiple currencies will experience dramatic declines relative to the dollar. The final currency war is clearly underway, in our view, catalyzed by the Fed's 2012 commencement of QE3, the ECB's 2012 announcement that if needed, it would engage in open-ended sovereign debt monetization, and the Bank of Japan's 2013 announcement that it intends to double the money supply in an attempt to dramatically weaken the yen. Consequently, these big three central banks have exported copious amounts of inflation worldwide, as highlighted by the most important article I've ever written. Fraudulent tapering notwithstanding, the global trend of increased money printing must continue and eventually accelerate as history's largest Ponzi scheme plays itself out. Consequently, the race to the base will intensify, yielding increased worldwide inflation and a surging dollar index. In time, this cancer will rise to the top of the totem pole, destroying the world's reserve currency itself. And currency destruction is indeed what is happening, at a rate far more intense and rapid than even I could imagine. Let alone, as we have not yet seen stock markets materially decline. Although frankly, I have all along said the Dow Jones propaganda average could just as easily destroy capital via hyperinflation, a la modern Venezuela and Argentina, or Weimar Germany, as a deflationary collapse, particularly with a PPT operating 24/7 to profit with unlimited money printing and algorithm transmitted buy orders. To that end, I have for years highlighted how central banks' ultimate point of no return, per an article I wrote on the topic, occurred in mid-2011 when they realized their post-2008 deer in headlights money printing, bailout, accounting changes, and propaganda were failing miserably. At that point, with the European sovereign crisis in full-blown spiral, the U.S. government itself losing its AAA rating, ironically, as it crossed a debt ceiling of $14.1 trillion compared to this weekend's breaching of the current $18.1 trillion debt ceiling, global stock markets plunging, and gold and silver achieving all-time highs, the Fed, ECB, BOJ, and other leading central banks decided to go all in printing money, read US QE3, Japanese Abenomics, and Draghi's whatever it takes speech, prompting the aforementioned historic exportation of inflation to all corners of the globe. Since then, a mere 3.5 years ago, as the various PPT mechanisms have launched key stock indices to all-time highs, while sovereign debt monetization schemes have taken global yields to 5,000-year lows, and the cartel has mercilessly pushed gold and silver prices well below the costs of both production and industry sustainability, the global economy has entered a depression far worse than in 2008, with exponentially higher debt levels. Meanwhile, nearly all currencies have been devastated, yielding not only worldwide inflation, geopolitical instability, and social outrage, but an acceleration of the final currency war I predicted 2 years ago. Consequently, the average currency is down more than 50% since mid-2011, whilst the so-called Fragile Five currencies, utilized by more than a quarter of the world's population, are down more than 50%. And the Fragile Five, I believe, are Brazil, Indonesia, Turkey, South Africa, and India. And how do the various chickens with heads cut off central banks react? By pouring kerosene on the fire, by lowering interest rates, often to new normal levels below zero, and initiating massive QE programs under the misguided, historically disproven assumptions that 1. Debasing one's currency will yield increased jobs and GDP production, and 2. The resulting nominal stock and bond market gains will yield a so-called wealth effect that will enable nations to grow out of their aforementioned exponentially growing debts. Other than the 1% actually receiving the free money and privy to the PPT-supported financial markets, such assumptions could not be more flawed or hubristic, which is why the world is on the precipice of economic, financial, monetary, social, and geopolitical implosion as we speak, which inevitably will express itself in a broad swath of ways. That said, this audio blog is focused particularly on the so-called BRICS nations that, for the past decade, have been hyped as the so-called savior of the global economy. The propagandist reasoning was that this group of 5 emerging nations, Brazil, Russia, India, China, and South Africa, given their cumulative technical capability, low-cost labor forces, abundant natural resources, and half the world's population, were set to take the mantle of economic leadership from the West. For a while, they grew at above-average rates, in large part due to rigged economic statistics, but equally so to understated inflation rates and, of course, the fact that growth was coming off extremely low starting points. The fact that none of history's of functional democratic governments, whilst 2 are outright communist, didn't factor into the good story of BRICS emergence. And here we are just 14 years after the term was coined, not uncoincidentally, at the turn of the century when the global economy peaked, with all 5 on the verge of economic and potentially political implosion. And nowhere is this more evident in the all-out collapse of their currencies, with the exception of China, of course, whose suicidal dollar peg is dramatically exacerbating its historical bubble collapse, yielding an extremely high likelihood of a near-term depegging, which, as I've discussed ad nauseum in the past 2 months, will be the most devastating global monetary event in history. To wit, since the aforementioned point of no return in mid-2011, the aforementioned Fragile Five currencies are down more than 50% against the dollar, compared to the global average of 40%. However, the so-called BRICS currencies are down during this period, on average, by, drumroll please, a whopping 90%, including 9% since the end of 2014 alone. And trust me, when China depegs the yuan, it too will sharply plunge, yielding not only an inflationary surge in China and a deflationary tsunami the world round, but it will cause yuan-priced gold to spike sharply higher in an environment where Chinese gold demand is already at record high levels. To that end, Brazilian real-priced gold surged to a new all-time high this week, whilst South African rand priced gold is just 7% below its all-time high, Indian rupee priced gold just 25% from its high, and of course, Russian ruble priced gold, which has doubled in the past year, blowing away its previous highs. And since gold and silver are the most price inelastic items on the universe on the planet, so to speak, giffen goods, surging prices will only cause demand to increase, just as we saw here in America in April 2011 when silver supply disappeared as it approached $50 per ounce. And trust me, whilst U.S. precious metals demand has been greatly weakened by years of price suppression and economic recovery propaganda, the polar opposite is occurring everywhere else. To wit, an email I received from a Mexican reader this week. Quote, gold is almost impossible to buy at a reasonable price, and since a few weeks ago, I can't get my hands on 1-ounce silver coins. Even if they are expensive, they are now gone. I used to buy at Banco Azteca, and they are telling me, until further notice, no silver coins. And by the way, the Mexican peso also is getting destroyed. And as more and more governments join and escalate the final currency war, precious metal demand will grow exponentially. And heck, this week alone, 4 separate central banks reduced rates, taking the number since year end to a whopping 24. Some, like Denmark, are going to negative interest rates. Some, like Sweden, are simultaneously launching QE programs. And most, like Russia itself, are actually lowering rates as their currencies are plunging, which not only reeks of logistical lunacy, but demonstrates just how desperate central banks are to prevent all-out, instantaneous economic and financial market implosion. But nowhere is the pain being more felt than in the BRICS nations, with the Brazilian real on the verge of taking out the all-time low achieved 13 years ago. The South African rand having just sliced through 2002's all-time low like a hot knife through butter, and the Indian rupee within 7% of the record low it achieved 2 years ago. And as for the Russian ruble, it's lost more than 50% of its value in just the past 9 months alone. Meanwhile, the Brazilian, Russian, and Chinese economies have plunged at freefall speed, with India and South Africa not far behind. In fact, India's supposedly pro-gold government, which swept into power last year due to the ill effects of a plunging economy and rupee, just lowered rates last week, mere days after receiving a mandate that it could target inflation. In other words, it won't be long before the currency of the world's most gold-loving people hits a fresh all-time low, just as its precious metal importation rules start to be relaxed. And as for South Africa, whose principal business is metals mining, its economy is being so dramatically devastated, it wouldn't surprise me one bit to see a new racially charged revolution break out. To wit, when I wrote The Rise and Fall of South African Mining 2 years ago, even I couldn't imagine the upcoming carnage caused by plunging metal prices, both precious and base, continuing labor battles, and electricity shortages, and of course an all-out collapse of the rand. Just look at yesterday's Huey Mining Index performance if you want to see the future of the massively high-cost South African mining industry, with the Huey roughly unchanged. AngloGold, the world's third largest gold miner, fell 4.5%, Harmony was down 3.4%, and Goldfields 3.2%. To that end, all three hit fresh all-time lows this week, down 86%, 91%, and 76% respectively from their 2006 highs, set, by the way, when the rand was trading at its highest level of the past 17 years. And thus, with the CRB index having plunged yesterday to its lowest level of the year, within 2% of 2008's spike lows, the dollar index having exploded above 100 to a level last seen in 2003, QE-infested sovereign debt markets at their highest levels in 5,000 years of trading, and the powers that be's other Achilles heel, crude oil prices, within a hair's breadth of last month's 7-year lows, the world is on the verge of political, economic, and monetary Armageddon, with even MSM cheerleaders like Yahoo Finance publishing top stories like China's economy, it's worse than you think, whilst real news purveyors like Zero Hedge are writing articles like foreign exchange volatility spikes as more countries enter the currency wars. And yet, incredibly, MSM propagandists are simultaneously publishing moronic headlines like the one that appeared this morning from Reuters claiming investors impatient panic over Fed, as if last week's U.S. equity turmoil was due to fears that the Fed will remove the word patient from this coming Wednesday's policy statement, just 2 weeks after Janet Yellen told Congress that not only is the Fed not considering rate hikes, but even if they were, they would first change the guidance in future FOMC statements to indicate such. And even if such guidance has changed, she made sure to emphasize, that doesn't necessarily mean rate hikes are even imminent. But more importantly, said propaganda ignores the giant pink elephant in the room of the fact that the real reason stocks are falling, which by the way is the Fed's biggest fear, is because commodities are plunging, the dollar is surging, and oh yeah, outside the fraudulent NFP employment reports, which the Fed itself has already de-emphasized, U.S. macroeconomic data is at its worst level since the heart of the 2008 financial crisis. Let alone the way that they measured, inflation has just gone negative, even including food and energy costs, or excluding. In other words, the walls are closing in on the trapped rats at the Fed, who desperately want to pretend the economy is recovering when not only does all evidence claim otherwise, but the global economy is collapsing along with commodity prices, currencies, and geopolitical stability. Let alone as the White House itself issued a threatening statement this week, coincidentally the week before the aforementioned FOMC meeting, claiming that the strong dollar is causing significant headwinds to the U.S. economy. In other words, the stage is set for QE4, and if the Fed doesn't hint at policy easing this time around, trust me, it's coming sooner rather than later. And certainly if the PPT can't regain control of the stock market, and definitely if the dollar index doesn't slow down its parabolic rise. Thus, amidst the obvious escalation of history's broadest, most destructive, and global currency collapse, I cannot emphasize enough how imperative it has become to protect your hard-earned savings with real money, as in the long run, physical gold and silver always protects wealth. And by the way, for those being scared off by the clueless, and in some cases predatory, fear-mongering by newsletter writers claiming to be fearful of technical analysis, I urge you to read the fine article penned this week by GATA's Chris Powell, titled Gold Market Sentiment Matters No More Than Technical Analysis, referring, of course, to the fact that all that matters is the battle between the desperate paper-bearing cartel and economic Mother Nature's physical gold and silver supply and demand fundamentals. To that end, if you decide to take action by buying or storing precious metals, we hope you'll call Miles Franklin at 800-822-8080 and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thank you.